Hello, welcome everyone. This is our first recorded interview of the year for our virtual bank conference. Thanks everyone for joining us. We have a guest today who makes a return appearance, Jay Hatfield, who is the CIO and founder of InfraCap Advisors. Jay's investment approach focuses on value, seeking favorable risk return situations, especially with respect to hard assets, real estate, pipelines, things like that. Jay had visited with us last year in May. Let's begin where we left off. Jay, take a victory lap. You presented us with a non-consensus view back in May that inflation would moderate and that the Fed would not have any more increases, and then in fact you expected that rates would come down, which on the long end of the curve it certainly did. Uh, where are we now? Where do you see everything now?
Well, first of all, thanks, and Julienne, for having me on. It's always a pleasure. Well, we have recently done a lot of work, just even over the last week or two, because we do have a very bullish outlook. I think the most bullish I've heard of for both the stock and bond market. So 5,500 on the S&P, which is about 15% from here, and the 10-year being 3 to 3.5. And the core of that bullish view is really that Europe in particular is heading into a recession, relatively mild, but heading into a recession. But this is true for both the US and Europe, that not only is inflation down, but even the Federal Reserve will figure out that it's down. And the reason I say that is that really our indicators, like we have CPI-R, which I think we might have talked about last time, that rolled over a year and a half ago. So all that does is take Case-Shiller and put it in for shelter. And most people probably have heard by now, the shelter component of CPI is just miscalculated. It's deliberately delayed by 6 months. So they only update it every 6 months. And it uses a lot of data that's also very delayed. So the Fed missed all the run-up inflation, which we didn't. And now they've missed most of the run down. But if you look at the data over the next 6 months, even their favored and slightly mismeasured index PCE core is going to roll down to probably at worst 2.5, maybe 2.2, because the last 6 months it's only gone up 0.88, which analyzes to 1.6. So even if it accelerates a little, you just roll off the back months, and then even the Fed will figure this out. And it's very simple arithmetic, and we shouldn't have to do it, but the Federal Reserve is stuck in their flawed framework where they look at the Phillips curve, which is employment, and say, oh, well, inflation is going to be bad because employment's bad, when the real, and hopefully we talked about this a year ago, the real indicators of inflation are energy prices and housing and rents. Rents and housing have come way down. Actually, now housing is coming up a little bit, but that's not even reflected in the index. And then most people recognize, because they buy gasoline, that we've had a big deflation in energy prices, 15% down in the last couple of months. So we're very bullish that inflation will continue to drop. It's already at a perfectly acceptable level, just not to the Federal Reserve. And then in not till mid-July, or at the meeting in July, will they probably cut rates? So that's why you're seeing this choppy market, because everybody kind of got ahead, like there's a 50% probability they're going to cut in March, which I think is zero. Again, they're conservative. They don't get bonuses for cutting early. So we're very bullish, but just be aware that we might be choppy, particularly for yield-sensitive stocks. Like the market's up today, but it's just because NVIDIA and Microsoft and the AI stocks are running and everything else is kind of weakish because rates are higher. So we think that maybe the rally we're predicting could be, particularly for our kinds of yield stocks and bank stocks, might be a little bit more back-end loaded. But when we do get these roll downs occur every month, like we're going to get one next Friday, and we're projecting PC cores 0.15, and we roll down, 0.2, which is a lot. So we're going to go below 3. So that data will be bullish, but in between rates might be gyrating around. So a little bit more choppy for 6 months, and then we should be off to the races in the last 6 months.
So in terms of the slope of the yield curve, if the Fed does cut, and I like I mean, Bostic today mentioned that maybe it won't be until the third quarter. But if the Fed cuts, does the long end go down with it, or do we end up seeing a positive slope? Because, for our banks that we follow, the not only the deposit rates are high, which hurts their net interest, but the yield curve isn't helping either.
Right. Well, what we would think is that the long end is likely to continue to rally. And there's a simple reason for that that almost no one appreciates. And I mean no one on Wall Street anywhere, is that the balance sheet and interest rates have to go together. So in other words, everybody's obsessing about QT. They don't realize it's completely irrelevant. The Fed is offsetting all the QT with short-term, what's called open market operations, because they have to keep the rate within that band. So actually the money supply is growing, not shrinking right now. So bank reserves plus currency. So if there's rate cuts, the only way to get the rate to go down, they do pay interest on deposits, which helps a little, but the only way to get it to go down is to increase the money supply, which puts more liquidity in the system and tends to drive up both stock and bond prices. And in fact, one thing that we had not figured out last time we met was that there was this gigantic sell-off in the bond market in July, August, September, and parts of October. And we really believe, nobody else does, but we believe that that was because the ECB was forced to reduce their money supply, this is raw money, currency plus reserves, by 700 billion just to get their rates to go higher. Keep in mind, they increased their rates very, very quickly, particularly for Europe, because they have lower rates in Europe. So they went up to 4 very rapidly. They had to shrink their balance sheet. That sucks liquidity out of the global capital markets and tends to drive long rates up. And then, the Fed became less hawkish, and then you saw the rates come down. We do have a new stat. It's the global monetary base. So you can track that. It's been negative over the last 18 months, but we think it's going to turn positive. And basically, it's a simple rule. You want to be long stocks when central banks are pumping in liquidity, driving stock and bond prices higher. But I do think, so for that reason, the banks, the regional banks are going to probably be sort of ambiguous on net interest income. Their deposit outflows will probably stop or slow down, but depending on how they're hedged and whether they're growing assets or not. And that's really what the bigger regional banks have been saying, is it's kind of like a mixed bag. We do think, this isn't favorable to your key focus, but we do think the investment banks are going to do quite well, just because we do think, we're already seeing it, a lot of stock and bond offerings. That does benefit, by the way, the bigger regionals like PNC a little bit, not a lot, but a little bit. And M&A is picking up. So we do think financials in general are going to do well, including banks, partly because their balance sheet's going to get better. The mark to market's going to get better, because if rates do go down, any bonds they own go up. But, net interest margin might be a little more neutralish. But if you have leverage to the capital markets, either through asset management or direct underwriting, then that's going to be positive.
So in May, I think you were right. Home construction remains strong throughout the whole year, and auto sales seem to be fairly robust, which you thought would keep us out of recession. Is that still your view? I think last time you were thinking that we could get down to some kind of 0 to 1% GDP growth. I don't know if you're still thinking that we'll slow to that level.
Strangely, we're actually more bullish than we were. So we're just at 2%, which sounds really high, but really 3 is potential. That's the average growth over the last 50 years. But the reason so we're in kind of the, I guess people call it no landing camp, so no real slowdown. And for exactly the same reasons you outlined, the housing market continues to be resilient, and we did do more research. So 11 out of 12 recessions were precipitated by housing crashes. And the only one that wasn't was a very mild recession in 2001. That was a tech crash. But it is always investment. So if you hear somebody on TV, we get kind of annoyed by a lot of our competitors who talk on TV because they're always like, oh my gosh, student loan payments, pandemic assistance, the consumer is going to implode and we're going to have a deeper recession. But that's just not the history. What happens is investment plunges, they lay people off, and consumers will spend less money if they're not working. That's the only thing that really impacts it. So in the average recession, there's 900,000 home starts every year. The worst was 500,000 during the financial crisis. That data just came out this morning, and we're 1.4 million. So very, normal, positive times. Autos continue to sell well and be a little bit in short, not as big as a shortage as it was a year ago, but continue to be in shortage. And it's probably the first time in 50 years since the Great Depression, we actually have counter-cyclical government spending going on. Keep in mind that most of the time, if you just leave it up to the politicians, they're like, oh, we better stimulate the economy, let's give everybody money. But that's actually not the best thing to do. The best thing to do, because again, consumption is pretty static. Doesn't matter, it's 2/3, it's static. So 2/3 isn't volatile, doesn't matter. But investment's 20% of GDP, very volatile. So the government really, because of the split Senate, so I call it Mansionomics, really only passed legislation that was focused on capital investment. So it was an accident, because politicians aren't great economists. But it's an accident. But so they're also supporting construction spending, which is keeping construction employment high, and then spending's normal. There's no big layoffs going on in any sector. So we continue to sing out of the same hymn book. And I think now that's much more consensus than it was last year and the year before.
Have you done any work relating, if your economy picture turns out, which is fairly positive, credit quality? Have you looked at bank credit quality and delinquencies in any of the work that you've done to see if there's a relation or any inference?
Definitely. And even Jamie Dimon, who tends to be a little bit too negative, as he should be, because he's managing this global bank, but even he acknowledged that the commercial real estate problem was manageable. It's not zero problem in the context of no significant recession. So it's almost always that cycle that we were talking about, not as much the fact that housing construction falls off, but then all those people get laid off. There's a lot of manufacturing that goes into construction. So obviously pipes, consumer durables like washing machines, those people all get laid off. And then there are defaults because their credit massively deteriorates. And so it's really the worst bank write-offs occur in a real recession. And it's even true for real estate, because really all other categories except office are fine. Retail sales are holding up. So retail's good. It's really just B and C offices. And the reason that we were more constructive than most even a year ago is that everybody fails to make these distinctions on real estate. First of all, not all office is going down. I'm in a sort of A office in Midtown Manhattan that's fine, pretty well leased. But there's a bunch of Bs and Cs that aren't doing well. But the leverage is relatively modest, usually about 60%. And the recoveries are relatively high, like say, even for a bad office building, maybe the recovery is 40 cents. So if you're a regional bank, you underwrote it at 60, you take a hit and you get 2/3 of that. Well, that should be covered by reserves. Maybe there'll be one or two banks that aren't properly reserved for that. Because keep in mind, that's just the office portfolio, so not all the real estate. So we think a lot like Jamie Dimon that, assuming you were correct about no deep recession, there'll be these turnovers of their office portfolios. And there's buyers at 40 cents on the dollar. Because like in Midtown Manhattan, you can rent out a B office building. It's just the rents are way lower. It's to like a I go to my dentist is in a B office building, high rise. So they're not getting $80 a foot, they're getting 30. But, if you buy the building at 40 cents on the dollar, and it used to be worth 100, there's private equity that'll come in and buy that. So I think that whole crisis was a little overdone because people are thinking about the housing crisis, which wasn't like that. When you get a default on housing, it's very hard to repossess it because the government doesn't really want you to. And if it's a $100,000 house, it might cost you 30 to repossess it. Whereas that's just not true in commercial. A lot of times it just automatically transfers over to the lender. So all these distinctions weren't really drawn. And there's a tendency for a lot of pundits to want to come in and say something dramatic, like, oh my God, all regional banks are going down because of office. When if you really sort through the economics, that's not very likely.
So if you had to, well, you do put money on this every day. Uh, is it important to see, or when do you think the first Fed cut would be, or is that even really important?
Well, I think it's important because, like I said, I don't think that we're going to have a problem in the market, but, our estimate is we're range bound at 4,600 to 5,000, which is fine, because that's basically kind of flattish. Because of this disappointment, like March is going to be disappointing, in our opinion, at least going to be disappointing, somewhat offset by every month we're going to get the roll down in inflation. So I think it's important to be aware of that because, like, let's say you really, everybody just followed exactly what we said, which is not, well, some of our clients do, but they would be like, well, wait a minute, I thought you said the market's going to 5,500 and my stocks are all down. If you don't own NVIDIA, like your stocks are probably down for the year. So what the heck's going on? Well, the answer is that this Fed moves slowly. They're going to need to see all the data in, and that is likely to occur in May. There's no June. Well, it ends in May. The data comes out end of May. There's no June meeting. So they're going to cut in July. But the reason I'm not too worried about our Fed, because they could be slower, like you mentioned, the Fed governor said, I think you said the fourth quarter, but third quarter would be consistent with what we're saying because that's July.
Yeah, Bostic said the third quarter. Yeah.
Okay, so he may have read our notes, probably not, but so that would be the third quarter. But the reason that we're not so worried about it is what I already said, which is you're going to get this lower inflation data almost for sure, unless oil prices spike. And so that's good data that comes out. Earnings should be pretty good because we didn't have a recession, so you're not going to have the write-offs and the other problems with earnings. So you have that, but the European economy is in a mild recession. That data is going to keep coming out. There was some mixed data that came out recently, but their inflation is going to roll down. So we think the ECB will move in June. They have a meeting in June, and that'll give cover to the Fed, and also it will cause global bond markets to rally. Because that's the other thing that you will hear from us, but almost no one else, is like, because a lot of US investors are like, oh my God, the budget deficit is terrible. We're all spendthrifts. That's terrible. But they don't realize, well, wait a minute, this is a global bond market. Sovereign bonds are. And so a UK gilt's very similar to a US 10-year, Canadian 10-year similar to the US 10-year. So if every other economy is cutting rates, increasing liquidity, keep in mind those go together, their rates are dropping. That's going to force our rates to drop. Mm-hmm. So yes, it's terrible that we have a profligate federal government that does reduce our economic growth a little bit, but that's not, everybody knows that. It's been true as far as I can remember since Bill Clinton was president. So that's not new news, but these rate cuts are new news, very powerful and likely to drive stock and bond prices higher, and they're likely to occur in other places first. In fact, it's basically irrelevant, but it still bodes well for the future. Hungary and Costa Rica have already cut rates. Totally irrelevant, but just indicative that the rest of the world is not doing as well as the US, including Canada, by the way, had negative growth. And so that's going to come first. So even if our Fed is a little bit slower, maybe it's not July, maybe it's August, September, we don't think it's the end of the world. And it's just a very simple thing. Just think of it, it's the Fed meeting, it's 2:00, and it gets announced, the Fed's cutting rates. Do you want to be long bank stocks or short? I want to be long. So don't overthink it. Say, oh my gosh, market's not good now, let me get out. and then you miss that power rally. Just like last year, we thought the pause would be the catalyst, happened more slowly than we would have hoped. A lot of hemming and hawing. But once it happened in December, it was like off to the races, particularly for bank stocks.
Any other questions on the economy, Julian, before we turn it over to your segment?
Right. No, I think so. Sanguine on bank stocks because of the interest rate trajectory, but also the backdrop of credit quality. What about the bank preferreds? So the last time we talked, this bank preferred securities are widely held on bank balance sheets.
Right.
They hold each other's bank preferreds. And so these were getting marked down precipitously in value in the wake of the bank failures. And interest rates aside, I think that just combined with the interest rates, it just really took the values down. And this hurt bank balance sheets because they had to mark those to market. And even if they didn't mark it to market, analysts such as us did mark it to market. So it hurt everyone. Maybe you can give us an update on the bank preferred securities, what they did since the last time we talked with you, overall. So the second half of last year, and what your outlook for those type of securities is.
Yes, definitely. So I think we were pretty constructive on most bank preferreds. I mean, might have been a little conservative on like the smallest of small ones. And we don't really, PFFAs are preferred stock fund. It's pretty big funds, 800 million. So we tend to do bigger companies anyway. But it turned out spectacularly well because even the companies are obviously Signature and Silicon Valley, those were wipeouts. We didn't have any in our fund. But PacWest merged. We do now own that merge. That's Bank One now, or Bank BANC preferred.
California.
Yeah, we like that. And the other ones that are under attack, like Western, they all ended up being fine. And so it was an opportunity to buy. We bought a lot. Some of those are returning closer to fair value. But we think that that'll continue, assuming we're correct about rates coming down, because rates do matter as well. And a lot of bank coupons are low, and that means their duration is long. So their interest sensitivity is higher than a lot of the ones we own in PFFA. So the trajectory of rates for financial preferreds are important. And we do think that regional banks will outperform, not just the money center banks, but outperform the market, because it's not just net interest income. It is exactly what you were talking about, Julienne, which is the real short thesis on banks was that their tangible book value mark to market, fully marked to market, was like 20 cents on the dollar. If we're right about rates dropping, then the preferreds go up, their bonds go up, and so their tangible book value rises dramatically. And we don't think there's going to be any write-offs. So even if earnings are lagging a little bit, the big short thesis goes away, and you can kind of see through to maybe not this year, but the following year, where, as Ian was pointing out, then you get upward sloping, and then that would be the ideal environment. Low defaults, upward sloping, no raids on regional banks. So we think that'll get anticipated, and they'll do fine. It's just that we don't think that people are as bullish about the market as we are. And so the money center banks are directly impacted by the stock market because they have money management businesses. And, it's true of our business as well. The market's up, we have more AUM, we get more income just because the price is higher. So they have that, they have underwriting and M&A. But we think all financials will do well if we're correct about long rates coming down.
So, where are we relative to where we were at the lows following the March failures? Like, have we recovered? Have the preferreds recovered that yet? Or are they still 50% below where they were, before the failures? I'm just trying to get a feel for how much more upside.
The way I would think about it is most of the credit gap has been closed. So that there's really not a lot of default risk built into them. But so what, a good example that we do hold in PFFA, it's like Bank of the Ozarks. There might have been concern about credit quality, a year ago. But we think that's de minimis. But then you might look at it and say, well, it's trading at 16. Well, why? Oh, well, that's a 4 coupon security. So this is why the rate, because with any preferred security, there's 2 risks. There's the default risk and there's interest rate risk. There's interest component, and then there's the spread over the interest rate. And so a lot of the financial preferreds are well below par. The average preferred, not just financials, is down 15%, but I would guess that the actual financial preferred would be 20 to 25% below par. And the only way that's going to close really is if rates drop back down to say even 3%. So then those 4% start to look better and they trade at 20 and not 16. So I would say most of the credit risk is out of the preferreds, but the interest rate risk is still hurting them. And so they actually have more upside than some of the preferreds that we own that are more like REIT preferreds that yield like 7, 8, 9. Because that's just their arithmetic. Low coupon securities have longer duration / interest rate risk, more interest rate risk than higher coupon preferreds. So I would look primarily not to the stock market, but to the bond market to drive those preferreds closer to par. But not all of them are going to go back to par. Like, I don't think we're going to have a 2% treasury anytime soon. So that Bank of the Ozarks is not likely to go back above par anytime soon.
So, so just talking about AOCI marks in general on bank balance sheets, are we near the end of the recovery, or is there a lot more? Like, can they get back? Do you think that? I mean, still AOCI is probably causing around 25% on average markdown in book values, stated book values. Do you see us recovering that, say, 25% on average anytime this year in 2024? Is it going to take longer? I'm just curious.
Well, we do, just keep in mind we're way out of consensus because, we're, let's say 3 to 3.5 is 3 1/4. That would get you most of the way back, on the long side. So, and then also if that's true, the credit quality would even tighten more. So we are bullish about that. I don't think that's quite consensus because, I think the average target on Wall Street is 5,000, which seems ridiculously low to me. But so we're 10% higher on stocks, and we're probably, I would guess most people think we're going to top out at 3 1/4 maybe on the 10-year this year. So it remains to be seen, but I would still go back to history and just say, if you just simply get long with stocks and bonds when central banks are easing, increasing liquidity, lowering rates, you're going to do extremely well, just like it was good to be out of the market in 21 when they were doing the reverse. So we're pretty built up that, yeah, that's why I think regional banks, they might trail the money center banks some, but they are going to benefit from their balance sheets going back to normal.
A revaluing, right, of the balance sheet. Okay, so Ian, did you want to talk about CRE?
Yeah, we can circle back. I know you hit upon it earlier. And I think, last time we spoke, you had a structure that, a lot of in the REIT side of the house, they're well capitalized. They can withstand, as you said, the banks, I think you believe also can withstand this commercial real estate issue. But I mean, how would you expect? I mean, we have a long way to go before probably commercial real estate, especially on the office side, valuations decline. Are you seeing, do you think, when does this balance out, or when does it bottom? Or do you think the whole change in working from anywhere has just permanently reset these prices lower?
Well, we're way more bullish about even the equity REITs or office. I mean, a little bit more tilted towards the A+ offices. So we've been recommending like Boston Properties, which is the biggest office REIT. Because one thing dynamic that I think people have missed is not like every business, like advisors are definitely not going in the office, but big financial firms, big law firms, even tech, which you wouldn't believe, but AI firms, they're what I used to call LFO, which is live from office. Because if you're just like when you're a junior investment banker, you do LFO. Like you don't even need a apartment. You can have a storage locker, shower in the gym. But because you sleep at night in the office, well, AI is a little bit like that. Because if you don't get your product to market, you're going to lose. It's like the internet boom 20, 30 years ago, 20 years ago. So, you're either going to become Google or you're going to become Webvan, but it's not going to be in between. So nobody appreciates that even in San Francisco, a lot of that excess office space is getting taken up by AI startups. In New York, most of financial firms are coming back at least 4 days a week. And by the way, if you're back 4 days a week, you still need an office. You can't have hot offices, hot desks 4 days a week. And also, if you're going to ask people to come back, like we have more office space now than we did before the pandemic, because we're making people come back. And a lot of them said, well, I want my own office. And we said, okay, we'll give you, it makes sense, pandemic and all that. So there's a lot of puts and takes that people aren't appreciating. So yeah, maybe there's some markets, but even in the suburbs, a lot of people are more willing to go in the office because it's easier. Like getting to Midtown Manhattan, if you're from New Jersey or Long Island, that's like an hour and a half. But if you live in the suburbs, drive to the office for 10 minutes, you might want to go in the office. So we think it's overdone. It's going to attenuate over time. There is data, people who work from home get promoted at 33% of the rate of people who work from office. So these things are going to sort themselves out. Some industries maybe will always have it, but other industries, people realize, oh, we're actually losing out to our competitors that work all, in their office most of the time, at least. So we think that it's actually overdone, but we're not saying rush out and go buy some suburban office building in St. Louis. We're saying, why don't you want to buy in San Francisco, the gateway cities, CBD? But if we're correct about all that, that means the banks will be fine because, yeah, they have a few write-offs, but some of the offices will be fine. So we just have to we really go building by building. And, if it's an unoccupied building in downtown San Francisco, that might be worth zero. If it's, Vornado here in Manhattan, they've got all brand new buildings, fully leased, that could be worth the 5 cap. So we got to go building by building.
So if your call is sort of right that the market perception is too pessimistic, I know you're traditionally would invest that through your REITs and your PFFR ETF,
Right.
which is the REIT preferreds. But have you started to look at banks and say, well, maybe there's opportunity within certain banks that have been overly punished? Are you starting to take a look at that?
Oh, definitely. So, we were fortunate. We haven't had a great track record of launching ETFs from good market timing perspective, because we just do it for other reasons. But we launched SCAP, which is our small cap value fund, and it's a dividend fund as well. And regional banks are a big portion of that, because they, not just banks, but all small cap stocks have been sold, way oversold. Because it's just simple. We know it from the Magnificent Seven. If you're in a downturn, it sort of doesn't even matter what the risk is. Large cap stocks are viewed as, particularly tech stocks, are viewed as safe havens. So everybody sells everything else, small caps, shorts them, shorts the IWM and says, okay, I'll short IWM. That's the Russell 2000. And I'll go long NVIDIA. And so that trade's been going on for 2 years. So a lot of these banks are super cheap. You can get them at reasonable high ROE banks that trade at reasonable multiples and have good dividend yields. So we do think it's an opportunity. You do have to be a little bit selective and make sure you're comfortable with the, commercial real estate, which is also, focused on office. But like I said, yeah, there's going to be write-offs there, but everybody has reserves. So you have to just assess whether the reserves are adequate to cover that. But we do think there's a big opportunity, and it's just normal. Hedge funds get excited and they go out and short every regional bank, and it works until it doesn't. It works. They all pile on and it starts working, and then it rips back like it did in the fourth quarter last year.
That's a good
I'm
segue
just
to your
curious.
final.
Sorry, I'm just curious, Jay. Why not small cap or even mid cap thrifts a little bit more, like especially thrift conversion names. These are highly interest rate sensitive names without excessive credit quality issues, tend to be highly capitalized, tend to be sellers, tend to be active capital managers, and also tend to be cheap. I'm just curious how you feel about those.
Yeah, we would just, I mean, we weren't, necessarily trying to say thrifts weren't, we're sort of using regional bank as a broad category, not excluding thrifts and conversions, which is a great business. So we're just really saying all small caps, particularly financials, whether they're thrifts or banks, even some money managers are cheap. So we think financials will outperform. Maybe money center banks do a little bit better, but if the market's at 15, regional banks are up 20, and money center banks are up 25, it's kind of a high class problem. And maybe also, maybe I don't see any evidences, frankly, but maybe we're too optimistic about investment banking coming back. But I can tell you, we get all the offerings, we get it offered to us. There's a lot of debt offerings, a lot of preferred offerings, a lot of equity offerings. So investment banking is already starting to come back.
Good. Julienne, do you want to switch over to talk a little bit more about the small cap and
Well,
banks?
I think we just did. So
Well,
yeah, I think we kind of addressed that section. If you would like, Jay, why don't we end with you talking about your new small cap fund and tell us whatever, and our listeners, whatever you'd like about it.
Yeah. Well, I mean, I guess maybe we could just move into one slide forward if you have that, if you can share that, Ian. But I can start talking without the slides too. You can move beyond the picture of me for sure. But and we talked about the first slide was about the macro. We talked plenty about that. But the one thing that I would emphasize that's not just related to small caps, it's this issue of there's a big misconception about the stock market, and that is that it's risky and gambling, when it's really the opposite. It is risky in that you do have volatility, short-term volatility, but if you invest in good companies like regional banks that make money and trade at reasonable multiples and retain earnings and invest them over time, the retained earnings are going to result in earnings growth. And so if you hold them over the long haul, you will make money. So what we've done with the small cap asset class is, so these are, we define that as less than 10 billion, is that, well, first of all, the sector is attractive. Julienne, you mentioned, smaller companies are just obvious M&A targets. Now, you can't acquire JP Morgan, but you can acquire smaller banks. They're inefficient. They're not well covered. They are domestic companies, which, if we're correct about the global economy, you want to be focused on U.S. companies. So we just think it's an attractive asset class in general, and it tends to be sold down hard during down cycles like we had over the last 2 years. So then the next slide is what I was really starting to talk about. So this is just distinguishing. So we do recommend, whether you use our fund, it's SCAP, or you just go and build your own fund, is that you do what we did, which is you focus on companies trading at reasonable multiples with obviously profitable and that pay dividends. Dividends are critical. It shows that you have a healthy company. Most regional banks have dividends. And you can see from the chart on page 6 that you wouldn't have thought this. You'd think, oh, well, I want to be in the riskiest biotech company in the Russell 2000, so it must have beaten the value companies. But because of this compounding of earnings and they're profitable companies, actually the value index has beaten the Russell 2000, which has a lot more biotech and tech. And so we can look at page 7. I'll just cover a couple more points. So this is just to show that, cyclically, small caps are very, very cheap. So they're trading like 9 multiples below the S&P. Normally, it's sort of flat to it. But this, you might say, oh, how could that be? But it's just normal in down cycles. You sell the riskier stocks, which are the smaller ones. We can go to page 8, I guess. And there's just price to book is just another way of looking at the same valuation. So they are cheap. And page 9 gets into what I started talking about is this distinction between just buying the IWM, which is the Russell 2000. And you can see from this chart, you get 18% of your portfolio is money losing. 38% don't pay dividends, only 44% pay dividends, and you get a weighted average PE of 29 times, which could work out okay, but might not, because the higher the PE, unless the growth really comes through, can have big drawdowns. And that does include a lot of companies that don't make any money, because sometimes they file for bankruptcy. Now, IWN is the value side of it. That's closer to what SCAP is like. So on the value side, only 13% are money losing, only 24% pay dividends. So 62% fall into the category we like and have reasonable multiples at 15 times. So we think that's the sweet spot. That's where it's cheap. That's where it's lower risk. And SCAP is actually 100% weighted towards dividend paying profitable stocks. So we think if you're going to take more risk in small cap, you should do it in a lower risk way with these higher quality companies that, are trading at reasonable multiples and pay substantial dividends. So that's kind of the key. I think there's maybe we can just go through the rest of the slides real quick. That we already basically covered this, that you negative, and this is just more disclosure that SCAP, we charge 80 basis points. The SEC yield is going to end up being closer to 6 or 7. Just that the fund just started out, so it's not that number is a little bit distorted. And you can see that we do have pretty, just like the index, pretty substantial weighting to financials, real estate, a lot of interest sensitive type companies. So we do think if rates come down, that small caps will outperform. So I think that's a good summary of, and this is more like disclosure type information of the small cap universe and the way we're accessing it through SCAP.
Okay.
Great.
All right. Well, that was great. Ian, did you have any other questions before we?
Well, just a general one about SCAP. How do you see that, if you're constructing a portfolio and somebody has a lot of, where do you see that coming in an overall portfolio, small cap exposures? If, for like my clients who I do asset allocation for, what has been the sort of your typical allocation? And now I guess you're bullish. I mean, how high would you go up in small caps?
Yeah, so I mean, just assuming you're basically 60-40. So like preferreds of a portfolio, we actually think preferreds could be 10% because they're lower volatility of your fixed income. But small caps, even though this is an income fund, so yield, over 6%, we do have some preferreds inside the small cap SCAP. So that does lower the volatility as well, because preferreds are less volatile than common. And you've seen that this year where like the Russell 2000 will be way down and SCAP will be kind of more flattish. But it should be in that 60%. In a normal market, maybe it'd be 5 of your total portfolio or about 10% of your equity portfolio. But to your point, you might want to be, shaded more to the 6, 7, 8. Particularly with our fund, I wouldn't necessarily do that with the Russell, the IWM, the big ETF, because you're basically like 30% of that is money losing biotech or money losing tech and biotech. But with our fund, like, okay, it's down, but so that means the 14 multiple became a 13 multiple and the 6% yield became 6.6. So it's okay to hold. Like it's, you don't want to necessarily be in Tesla trading 100 times earnings when it goes down 50%. But if you're in Coke and it goes from 60 to 30, chances are it's going to go back to 60. So I think you could be a little bit more aggressive, but a normal market, normal portfolio, 5% of your overall portfolio or about 10% of your equities.
Okay, great. Well, that's terrific. Thank you so much for your time, Jay. It was fascinating.
And it was always a pleasure, Julienne. It was great questions, and hope to talk soon.
All right, thanks again.
Thank you very much.